Something is happening right now in the American banking system that should terrify every single person watching this video. While you were sleeping, while you were scrolling through social media, while you were living your normal life, America's biggest banks have been quietly making a move that signals they know something we don't. They're hoarding cash, massive amounts of it. We're talking about hundreds of billions of dollars being pulled out of the economy and locked away in vaults. This isn't normal. This isn't cautious. This is preparation for something catastrophic. And if you don't understand what's happening right now, you could lose everything you've worked for. Stay with me, because what I'm about to reveal will change how you see your money, your bank, and your future. This is the silent collapse, and we need to talk about what your bank isn't telling you. Let me paint you a picture of what's actually happening behind closed doors. JP Morgan Chase, the largest bank in America, is currently sitting on over $400 billion in cash and cash equivalents. $400 billion. Bank of America has increased their cash reserves by almost 60% in the last 18 months. Wells Fargo, Citigroup, Goldman Sachs, every major institution is doing the exact same thing. They're building war chests. They're preparing bunkers. They're acting like people who know a storm is coming. And here's what should send chills down your spine. Banks make money by lending money. That's their entire business model. When banks stop lending and start hoarding, it means they're more afraid of what's coming than they are excited about making profits. Think about that for a second. These are institutions run by some of the smartest financial minds on the planet, people with access to data and economic intelligence that you and I will never see. And they're choosing to sit on cash instead of putting it to work. Now, before we go any further, I need you to do something for me. If you're getting value from this video, if this information is opening your eyes to what's really happening, hit that like button right now. It takes 1 second, and it helps this message reach more people who need to hear it. And if you haven't subscribed to The Silent Collapse yet, do that now, because we're one of the few channels telling you the truth about what's happening to your money while mainstream media keeps feeding you distractions. We're building a community of people who refuse to be blindsided by the next financial crisis. All right, let's keep going. So why are banks doing this? What do they know that we don't? To understand what's happening, we need to look at the bigger economic picture, and I'm warning you, it's not pretty. First, let's talk about commercial real estate. You've probably heard bits and pieces about this, but let me spell it out clearly. The commercial real estate market in America is collapsing. Not declining, not correcting, collapsing. Office buildings in major cities are sitting empty. Companies that went remote during the pandemic never came back. The demand for office space has fallen off a cliff and property values have gone with it. But here's the part that connects to our banks. Who do you think loaned billions of dollars to the companies that own these buildings? Who do you think gave mortgages on properties that are now worth 30, 40, sometimes 50% less than they were 3 years ago? Your banks, the same banks that are now hoarding cash. There's a term in banking called non-performing loans. These are loans that aren't being paid back. And right now, non-performing commercial real estate loans are skyrocketing. We're seeing delinquency rates that haven't been this high since 2008. Remember 2008? Remember what happened when banks were holding too many bad loans and didn't have enough cash to cover their losses? The entire financial system almost collapsed. Banks failed. People lost their homes, their savings, their retirement funds, and the banks that survived only did so because the government bailed them out with your tax dollars. Now, I'm not saying we're definitely headed for another 2008. What I'm saying is that the banks are acting like we are, and they have information we don't. But commercial real estate is just one piece of this puzzle. Let's talk about interest rates. The Federal Reserve has been playing a very dangerous game for the last 2 years. They've been raising interest rates at the fastest pace in 40 years. Trying to fight inflation. And yes, inflation has come down from its peak, but the side effects of these rate hikes are starting to show up everywhere. Higher interest rates mean higher borrowing costs for everyone. Businesses can't afford to expand. Consumers can't afford to buy homes. Credit card debt is at an all-time high because people are getting crushed by interest payments. And here's the kicker. When interest rates go up quickly, the value of existing bonds and securities goes down. Banks hold massive portfolios of these securities. Many of them are now sitting on huge unrealized losses. We saw this play out in real time last year when Silicon Valley Bank collapsed. They had billions in securities that had lost value, and when depositors got scared and started withdrawing money, the bank didn't have enough liquid cash to meet the demand. They failed almost overnight. And Silicon Valley Bank wasn't some tiny community bank. It was the 16th largest bank in America. If it can happen to them, it can happen to anyone. That's why banks are increasing their cash positions. They're building liquidity buffers. They're making sure that if depositors panic and start pulling money out, they have enough cash on hand to meet the demand without having to sell their underwater securities at massive losses. They're trying to avoid another Silicon Valley Bank situation. But here's what keeps me up at night. If the banks are this worried, if they're this defensive, what does that tell us about their confidence in the economy? What does that tell us about what they think is coming next? First, let's address the elephant in the room. Is your money safe in the bank? The short answer is, it depends. If you have less than $250,000 in a single bank account, your deposits are insured by the FDIC. That means if your bank fails, the government will give you your money back, up to that limit. But here's what you need to understand. The FDIC insurance fund has about $120 billion in it. Total insured deposits in the American banking system are over $10 trillion. $10 trillion. If multiple major banks failed at the same time, the FDIC fund wouldn't come close to covering all the losses. Now, would the government step in with more money? Probably. They did in 2008, but it would take time. And in a crisis, time is everything. You could have your money locked up for weeks or months while they sort things out. That's not a situation you want to be in. So what should you do? Diversification is key. Don't keep all your money in one bank. Spread it across multiple institutions. Make sure each account stays under the FDIC insurance limit. Consider credit unions, which are often more conservative and community-focused than big banks. Keep some cash physically on hand for emergencies. Not your life savings under your mattress, but enough to cover a few weeks of expenses if ATMs stop working or banks temporarily freeze accounts. Second, think about your debt situation. If you're carrying high interest debt, especially credit card debt, this is the time to get aggressive about paying it down. In a recession, job losses increase. Income becomes uncertain. The last thing you want is to be buried under debt payments when money gets tight. Make a plan. Cut unnecessary expenses. Throw every extra dollar at your highest interest debt. I know that's not fun advice. I know it's not easy. But it's necessary. The banks are preparing for hard times. You should too. Third, let's talk about investments. If you have money in the stock market, you need to be realistic about what could happen. We've had an incredible run over the last couple of years, but that doesn't mean it will continue. When banks tighten lending, when consumer spending drops, when corporate profits decline, stock prices follow. I'm not saying sell everything and hide under your bed. But I am saying take a hard look at your portfolio. Are you overexposed to risky assets? Do you have a diversified mix that includes some defensive positions? Do you have an emergency fund outside of the market that can carry you through a rough patch? If the answer to any of these questions is no, it's time to make adjustments. Talk to a financial advisor if you need to. This isn't the time to be complacent. Fourth, consider your job security. I know this is uncomfortable to think about, but in an economic downturn, layoffs happen. They're already happening in tech. They're happening in finance. They're starting to spread to other sectors. Make yourself as valuable as possible at your job. Update your resume. Build your professional network. Consider developing skills that make you more marketable. Have a backup plan. What would you do if you lost your income tomorrow? How long could you survive? These are questions you need to answer before you're forced to. Fifth, think about alternative stores of value. I'm not going to tell you to put all your money into gold or Bitcoin or any specific asset, but I will say this. When faith in the banking system and the currency starts to waver, people look for alternatives. Precious metals have been a store of value for thousands of years. They're tangible. They're not dependent on any institution. Some people are turning to cryptocurrencies, viewing them as a hedge against traditional finance. I'm not endorsing any particular strategy, but I am saying it's worth understanding your options. Do your research. Talk to people you trust. Don't put money into anything you don't understand, but don't ignore alternatives just because they're unfamiliar. Now, let's circle back to the banks and what their behavior is really telling us. The fact that they're increasing cash positions isn't just about being cautious. It's about survival. Banks have seen this movie before. They know how it ends. They remember 2008. They remember the panic, the bailouts, the congressional hearings, the public outrage. They don't want to be the next Bear Stearns or Lehman Brothers. They don't want to be the next Silicon Valley Bank. So they're building fortress balance sheets. They're preparing for siege warfare. And that preparation, that defensive posture, is one of the clearest signals we have that trouble is on the horizon. Because banks don't hoard cash when they think the economy is about to boom. They hoard cash when they think it's about to bust. There's also a psychological component to this that we can't ignore. Banking is built on confidence. Your deposits in the bank aren't really there. The bank has lent most of that money out. It's a fractional reserve system. If everyone tried to withdraw their money at the same time, the bank wouldn't have it. That's why bank runs are so devastating. Once confidence is lost, once people start to panic, the whole system can collapse incredibly quickly. And here's the scary part. We live in the age of social media and instant information. If a rumor starts spreading that a bank is in trouble, people can pull their money out with a few taps on their phone. We saw this with Silicon Valley Bank. The run happened in hours, not days. The speed of modern communication has made the banking system more fragile, not less. Banks know this. That's another reason they're keeping more cash on hand. They're trying to stay ahead of potential panic. Let me give you some perspective on the scale of what we're talking about. The total cash and cash equivalents held by the largest U.S. banks have increased by over $700 billion in the last 2 years. $700 billion. That's money that's not being lent to businesses. That's not being used to create jobs. That's not flowing through the economy. It's sitting idle, earning minimal returns, because the banks have decided that safety is more important than profit. When has that ever been the case in banking? Banks are profit-maximizing machines. The fact that they're willing to sacrifice returns to build cash hoards tells you everything you need to know about their outlook. And it's not just American banks. This is happening globally. European banks are increasing reserves. Asian banks are pulling back on lending. Central banks around the world are in tightening mode. The entire global financial system is contracting. And when the system contracts, liquidity dries up. When liquidity dries up, asset prices fall. When asset prices fall, wealth evaporates. It's a deflationary spiral, and it's incredibly hard to stop once it starts. The Federal Reserve and other central banks will try to fight it by cutting interest rates and printing money. But there are limits to what monetary policy can do. You can't force banks to lend if they don't want to. You can't force consumers to spend if they're worried about losing their jobs. And you can't force businesses to invest if they don't see demand for their products. This brings me to a critical point about timing. I don't know exactly when the next crisis will hit. Nobody does. It could be 6 months from now. It could be 2 years from now. But the warning signs are flashing red. The banks are telling us, through their actions, that they're preparing for something significant. And the longer this buildup continues, the worse the eventual release of pressure will be. Think of it like tectonic plates building stress before an earthquake. The longer the stress builds, the bigger the quake when it finally hits. That's where we are right now in the financial system. Stress is building, imbalances are growing, and the banks are battening down the hatches. Here's what I want you to take away from all of this. You are not powerless. You can't control what the Federal Reserve does. You can't control what the banks do. You can't control the global economy. But you can control your own financial situation. You can make smart decisions. You can prepare. You can protect yourself and your family. And that's exactly what you should be doing right now. Not panicking, not burying your head in the sand, but taking measured, intelligent steps to secure your financial future. Because when the storm comes, and I believe it is coming, the people who prepared will weather it. The people who ignored the warning signs will be swept away. Before we wrap up, I want to leave you with a few action items. These are things you can do this week, right now, to start protecting yourself. Number 1, review your bank accounts. Make sure your deposits are under the FDIC limits. If they're not, open additional accounts at different institutions. Number 2, check your debt. Make a plan to pay down high-interest obligations. The less debt you have, the more flexibility you have in tough times. Number 3, build an emergency fund. If you don't have one, start today. Even if it's just $50 a week, it adds up. Aim for at least 3 to 6 months of expenses in cash that you can access quickly. Number 4, review your investments. Make sure you're not taking on more risk than you can afford. Diversification is your friend. Number 5, strengthen your income. Whether that means getting better at your current job, developing new skills, or creating side income streams, do whatever you can to increase your financial stability. Number 6, stay informed. Subscribe to channels like The Silent Collapse that are giving you real information, not corporate media propaganda. The truth is, we're living through a critical moment in financial history. The decisions being made right now by central banks, by governments, by major financial institutions are going to shape the economy for the next decade. And your decisions, the actions you take personally, are going to determine whether you come out of this stronger or weaker. Choose wisely, prepare diligently, and whatever you do, don't ignore the warning signs. The banks are telling us something. It's time we listened. This has been The Silent Collapse. Stay vigilant, stay informed, and I'll see you in the next video where we'll continue uncovering the truth about your money and the system that controls it. The more you understand about what's happening, the better decisions you can make. And listen, I know this video has been heavy. I know it's not fun to think about financial crises and bank failures and economic collapse, but ignoring reality doesn't make it go away. It just makes you unprepared when it hits. The banks are preparing. Shouldn't you? This is exactly why the silent collapse exists, to give you the information and perspective you need to navigate the financial storms ahead. If you found this video valuable, do me a favor. Share it. Send it to your family. Send it to your friends. Post it on social media. The more people who understand what's happening, the better prepared we all are as a society. And drop a comment below telling me what you think. Are you worried about the banks? What steps are you taking to protect yourself? Let's build a community of informed, prepared individuals who aren't going to be caught off guard.